Okay, so today we're gonna cover chapter 4 and 5, which is closing entries and temporary permanent accounts, closing entries, purchase and sales return. So as our first activity, I'm gonna give you guys a worksheet, not a worksheet, but something to read and to refresh your memory about closing entries and temporary and permanent accounts so that you guys know what I'm talking about. So let me quickly get that document for you. And you can also use that document to follow along. I'm sorry, my computer is not working to its best today. So for those of you who are joining the session late, there are some rules for these sessions that you cannot have your cameras on and you cannot unmute yourself to talk. So it would be great if you can have your cameras off for only Friday sessions. I would be more than happy to see your faces in the weekday sessions. So yeah. Okay, I shared a document in the chat. Take about 2-3 minutes to go through just the first kind of paragraph and the bullet points on it. Those are the steps for closing entries and those are fill in the blanks. So take help from your notes to see if you can identify those fill in the blanks. And discuss about what are temporary or look for what are temporary and permanent accounts. Okay. Access the document. Let me just change the settings. Okay. You should be able to, access it because it is set to the. Okay, now I see some of you are already on the document. I don't know what happened. I did not change any settings, but yeah, I'll share that document again. Okay. So take about a few minutes to go through that so that you can have your memories refreshed for formulas and when you guys are done reading or looking through your notes or textbook or whatever help you are taking, I want you guys to type in the chat just a few phrases or words for difference between temporary and permanent accounts whenever you're ready. So I'll wait for 4 or 5 responses before moving forward. Okay, so now I got a few responses in the chat. Let's discuss about what are temporary and permanent accounts first. So as you guys mentioned, temporary accounts are those which are in the income statement, and permanent accounts are those which are in the balance sheet. Permanent accounts are never closed, and temporary accounts are closed at the end of every period, whether it's monthly, yearly, or half yearly. Yes, Angela, temporary accounts are carried from one accounting period to other, and permanent accounts are not. Yes, all the income statement accounts are temporary accounts, and all the balance sheet accounts are permanent accounts. All right, any questions on this topic? If you have any questions, then feel free to type in the chat. I'll go through that one more time. Yes, temporary accounts include revenues and expenses. Permanent accounts include assets and liabilities. Okay, if we do not have any question, let's move on to next topic that I wanted you guys to think about, which is steps for closing entries. So first step for closing entry is, so this is the slide for temporary and permanent accounts. And okay, first step for closing entry is debit each revenue account for its balance and credit income summary. The reason why we debit revenue account is that revenues we know that have a credit normal balance. In order to close them, we need to debit it. We need to reverse that entry. And credit the income summary account, which is our account that we use to close the entries. It doesn't have any specific place in the accounting, but it is only used for closing part of accounting. And the opposite treatment for expenses, where we are supposed to credit each expense account and debit the income summary, because we know that expenses have a normal debit balance. To close them, we are going to credit them to zero out the balance. And when we are done closing the revenues and expenses, we are gonna either have a more balance on the debit side or on the credit side. When we have more balance on the credit side, which is expenses, right? Then we are gonna credit the income summary to account for the loss. Or if there is a more balance on the debit side, which is our revenues, then we're gonna debit the income summary and credit the retained earnings for the amount of net income. So whichever balance you have in the income summary account, you're gonna do the opposite of that to close the income summary to retained earnings, so that you can close that income summary account, which was not really an account, but just used to close the revenues and expenses. And the last step is to debit the retained earnings balance for the balance in dividends account and credit the dividends. For the same reason, dividends have a normal debit balance as expenses, but we are crediting it to close it, to zero out the balance. So you have the document to follow along. If you were not able to finish if for any reason, the fill in the blanks, you can take help from the slide when we're gonna do the actual problem for solving debit and credit or closing entries, not debit and credit. Okay, so now let's do our first topic for today, which is closing entries. If you guys have any questions, I'll pause here for a moment and then we can start. Okay, so let's start our first topic for today, which is closing entries. Here is the problem. So take about 2 minutes to read the problem, go through it and see if you can solve it on your own. You don't have to actually solve it, but just think about it. We'll go through the solution later, but it's helpful to think about it first rather than just me talking about which account is going to be debit, which is credit. I'll give you guys a chance to work on it in the breakout rooms as well. So it's important to think about the problem first and then look through the solution. I'll pause here for a minute or two, and then we can go through the solution. Normal balance, we are going to debit the service revenue for 108,000 and credit the income summary, which is the account that we use for closing. And we have the opposite treatment for expenses. Since they have a normal debit balance, we need to credit all the expenses. So in this problem, we had salaries and wages expense for 40,000, rent expense for 18,000, utilities expense for 8,000, supplies expense for 6,000. And these are all the expenses that we had for our problem. And we are going to debit the income summary for the total of all these expenses. So these are the first two journal entries for closing the revenue and closing the expenses. Now I'll pause for 30 more seconds. Which side do you think is greater for income summary? Is it debit? 72,000 for the debit side of the income summary. So we have credit side as greater than the debit, right? So we have more balance left on the credit side, which is our revenue. And to close the income summary, we know to cancel out, we need to debit the income summary, right? Because it has more balance on the credit side. So we are debiting the income summary for the difference between these two numbers, 108,000 and 72,000, sum of our revenue and expenses. Debiting income summary and crediting the retained earnings. This is our third step for closing entry. We are closing the income summary account to the retained earnings account. All right, let's move on to the fourth step, which is closing dividends. Dividends, we know that have a normal debit balance. So in order to close them, we are going to credit the dividends expense for this problem, which is 22,000. And we are closing that dividend accounts to retained earnings. So debit retained earnings, credit dividends to close it. So these are the four steps or the four journal entries for closing our accounts. If you guys have any questions, feel free to type in the chat, and I'll pause here for 30 seconds, not 1 minute. So there's a question in the chat: was income summary a debit because the retained earnings was positive 36,000? Yes, that is one way to remember, because we had a positive balance on the income summary, which means we have net income. And when we close the income summary account with net income, we have to debit it because there was more balance on the credit side, the income, right? Income or the revenue side. So in order to close it, we're going to reverse that entry, and we are closing it to retained earnings. So debit income summary, credit retained earnings. Similar problem in the breakout rooms. This problem is already on your document that I sent you earlier. I'm gonna stop share here. Okay, so this was the problem that I wanted you guys to go over in the breakout rooms and think about the answer. So if you guys are ready, you feel free to type your answers in the chat. What's the first closing entry? What's the second, third, fourth? Before we actually look through the answers. So I'll wait for another 1 minute for you to type. Okay, thank you so much for your responses in the chat. So let's look at the problem and solve it step by step. The ledger of the RIAS company contains the following balances. Retained earnings 30,000, dividends 2,000, service revenue for 50,000, and then we have all our expenses. We need to prepare the closing entries for December 31st. So first step is to close the revenues. Revenues have a normal credit balance. To close the revenue account, we are debiting 50,000 service revenue, and we use income summary to close it. And opposite for the expenses, debit income summary and credit all the expenses, which is salaries and wages 27,000, 7,000 supplies expense. And I think that's it for the expenses for this problem. And the third step is to close the income summary account to retained earnings for the balance that we are left with in the income summary. So 50,000 on the credit side, 34,000 on the debit side. So the difference is 16,000. We are debiting the income summary because we have more balance on the credit side, which is net income for our business, and we are closing it to retained earnings. And the last step is to close the dividends. Again, dividends have a normal debit balance. To close them, we are crediting the dividends to retained earnings, which is a permanent account that we use in our balance sheet or trial balance. So here's the solution for your breakout room problem. I know you guys did great. You guys are almost there. So yeah, great job, everyone. Okay, let's go to our next topic for today, which is purchase and purchase returns. We do one problem for this, and another one would be for sales and sales return. So this is all according to perpetual inventory system. We are not using periodic inventory, which is another method. So under perpetual inventory system, we maintain our inventory every time the sale is made or every time we purchase some goods. So keeping that in mind, here is the problem that we're going to work on today. Prepare the journal entries to record the following transactions on the Robertson Company's books using a perpetual inventory system. I'll wait here for 30 seconds for you guys to read the problem and think about what could be the journal entry for the first problem, because we are only purchasing goods and that is also on credit. I'm giving you guys one hint. So take about 30 seconds to 1 minute to think about what could be our first entry, or at least what are the for your responses in that chat for those of you who are answering. So for this problem, we are recording the journal entries for purchasing merchandise. So the first is on March 2nd, Milky Company sold goods of 800,000 of merchandise to Robertson Company for the terms 210 net 30. So we are Robertson Company. So we bought goods for 800,000, but that was on credit, so right? Debit inventory, because our inventory is going up, it's an asset. It's increasing, so it's a debit. Since we are not paying for the inventory, we are crediting accounts payable instead of cash because we're not paying them. We're going to pay them later. So that's the first journal entry. And in the next journal entry, we returned goods worth 100,000 on March 2nd. On March 6th, sorry. The ones that we purchased on March 2nd, we returned them on March 6th. So when we return the goods, our inventory will go down. That is going to be the credit to inventory, which is an asset. Whenever an asset decreases, it's a credit. And debit to accounts payable, which is our liability. It is also decreasing, and when there's a decrease in the liability, it's a debit. So simply reversing the first entry. When we purchase goods, debit inventory. When we return them, so it's credit inventory. And same for the accounts payable. And the next part was, let me go back to the question real quick so that you guys can see it. On March 12, Robertson Company paid the balance due to the Milky Company. So we bought 800,000 of goods, but we returned them 100,000. So we were left only with 700,000 worth of goods, 700,000 accounts payable balance. But they also mentioned something about credit terms, which is 210 net 30. This phrase means we will get a 2% discount on whatever the amount we owe if we paid within 10 days. If we did not pay that amount within 10 days, we have to pay the whole amount in 30 days. So 700,000 were due, and since we are paying within 10 days, so from March 2nd to March 12th, it's 10 days. So we are eligible to get that discount. 700,000 accounts payable that's something we are paying off, so our liability is decreasing. It's a debit. And we are getting the discount of 14,000, which is 2% of the amount due. And we are actually only paying 686,000. So credit cash for 686,000. We are crediting inventory here because we are getting the discount. That's why we no longer need to pay for that. So yes, thank you for your answers in the chat. So this is how we record purchase and purchase returns under perpetual inventory system. The important thing to remember here is to calculate this balance, 700,000. You're not going to apply the 2% discount on the whole amount, but the net purchase, 800,000 minus 100,000 returns to get the actual payable due. And then see if it is within the discount period, within 10 days or whatever the credit terms are for your supplier. Type in any questions if you have for purchase before we move on to the sales. Actually means net 30 means you have to pay the net amount if you within 30 days if you did not pay that within discount period. So from, let's see, March 2nd to March 12th, it is 10 days, right? If we are paying within that time frame, we will get the discount. But if we pay from March 12th to March 30th, which is, or April 2nd, 30 days, we have to pay the full amount within 30 days. Full amount net, yes. 700,000, not 800. I mean, 800,000, not 700,000. Okay, let's move on to the next topic. If you guys don't have any questions on that, on the previous one. So let's do sales and sales return. Can anyone tell me a contra sales revenue account that we use? I know some of you already mentioned, but what's the full name for that account that we use when we return, when a customer returns us goods that we sold them earlier? Yes, that is correct. So sales, returns, and allowances. Okay, let's read the problem first, and then we'll do the journal entries for it. Prepare the journal entries to record the following transaction on Wendell Company's books using perpetual inventory system. On March 2nd, Wendell Company sold 700,000 of merchandise to Krista Company for 210 net 30 credit terms. The cost of the merchandise sold was 460,000. This is where we're going to use our cost of goods sold. This is the cost of goods that we sold, right? And next transaction is Krista Company returned 80,000 of the merchandise and its cost was 54,000. Again, we are going to use cost of goods sold here. Finally, on March 12th, Wendell Company received the balance due from Krista Company, which is also within that discount period. So we need to take care of this 210 net 30 credit terms. I'll pause here for a moment for you guys to think about this problem, and then we'll go over the solutions. Goods. When we sell the goods, we earn revenue, right? And when we earn revenue, revenue has a normal credit balance, and increase in revenue is a credit. Since we are not receiving cash, we are going to receive it later. So we are going to debit accounts receivable, which is an asset. So debit accounts receivable for 700,000 and credit sales revenue for 700,000. This is the amount of goods that we sold. Since we are selling the goods, there is also the cost of goods that we incurred to sell them, which is decreasing our inventory. So debit cost of goods sold and credit inventory, which is an asset and it's going down. Our inventory goes down when we sell, so it's a credit. And inventory will go down by its actual cost, not the selling price. So actual cost is 460,000 and the selling price is 700,000, or the sales revenue that we got. Debit cost of goods sold, credit inventory as it is going down, and the amount will be the actual cost of the goods. First step, selling the goods and decreasing the inventory for the cost. Next journal entry was returning this. When the customer returns us the sold goods, we are basically reversing this first entry, but we are using contra sales revenue account, sales returns and allowances instead of just sales revenue, because we want to keep that separate for other managerial purposes so that we can know why the goods were returned and all that stuff. That's why we use a different account, contra sales revenue account. Debited because we are getting our goods back, and credit accounts receivable to decrease the amount that we are not receiving, that we are not going to receive in future. And when the goods are returned, our inventory increases by the cost again. And we are reversing the second entry, decreasing or increasing the inventory, which is an asset. So that's why debit inventory for 54,000 and credit the cost of goods sold for 54,000, because it is also decreasing since we are getting the goods back. Okay, before we move on to the third journal entry or the third part of the problem, I want you to calculate which is the what's the amount that is due from our customer before even calculating the credit terms. What's the amount that where we can apply, if applicable, the credit terms? Is it 700,000, the amount that we actually sold, or something else? So I'll pause here for a moment for you guys to think about it. Yes, that is right. So they need to pay us 620,000 since they returned us 80,000 worth of goods out of 700,000. And we also know that they are paying us within our credit terms or the discount period that we gave them. So there we have to subtract that discount as well. So yes, you guys are correct. 620,000 is the amount that they owe us, but since they're paying within that discount period, we have to subtract that 2% discount as well. So 700,000 minus 80,000, which is our accounts receivable. And they also qualify for a 2% discount. So 2% of 620,000 debit sales discount, with the amount is 12,400. And the net cash that our company is going to receive from that customer is 620,000 minus the discount. So 676. Oh, come on. 677,600. Okay. So any questions on how we can calculate net discount, net sales revenue, or accounts receivable? Okay, if you guys don't have any questions, so that's all I had for today's session. Thank you so much for attending.